Welcome to Amazing Cars. We have high hopes for your ability to grow this firm into the future. We have spent the past 10 years dedicated to building this company's core strategy and products. And while the past couple of years have been challenging, we fully believe that under your leadership, Amazing Cars will prosper. To determine our initial strategy, we looked at our starting portfolio and customer microsegments, as well as our existing technological capabilities. Based on our analysis of those areas, we determined our strengths and future targets, which informed our functional priorities.
Strategy, awareness, and a bit of luck is the formula for success, and that was no different for Amazing Cars. Our company's values were quality and safety, and we strategically aligned with the low-margin, high-volume market. When it came to R&D and technology investments, we focused heavily in these metrics as well. In the past 10 years, we've seen a lot of growth followed by an unexpected decline in shareholder return. We've been proactive, launching a new truck, Alamo, in year 4, an AEV, Ariel, in year 7, and a minivan, a van, in year 9. We've learned a lot along the way and want to share some of our key insights with you. To help you understand our roller coaster of a decade, we'll be using the analogy of a high-stakes poker game. Winning in this business is similar. It takes a lot of strategic thinking, attention to competitors, and some smart risk-taking to succeed.
To win the game, you have to know the rules. Let's start by talking about how this game is played. Here at Amazing Cars, we value collaborative decision-making that considers the current market and competitive environment, anticipated changes, and most importantly, our existing strengths. Over time, our team has established a series of steps to successfully execute business decisions. We started by reviewing past performance before discussing our goals and strategies for the coming year. After setting these tasks, we went to work forecasting future sales, evaluating our competitors' maneuvers, and analyzing new opportunities. We checked in regularly to share our learnings and collaborate. Once our individual tasks were complete, we reviewed all decisions for the year as a team to critique, ask questions, and adjust as needed. Over time, we developed more refined methods of understanding our customers and possible changes in the industry. We rotated our areas of focus and refined our forecasting methods, which helped us better predict production and inventory levels. While investigating new products or strategies, we considered financial, marketing, and operating implications.
In terms of financial decisions, we monitor economic variables and our profitability prospect through pro forma financial statements. Also, we compare after-tax cost of debt and cost of equity in each period to find one that costs less and adjust accordingly if possible.
For marketing, we use several tools and reports such as concept testing, focus groups, microsegment analysis, and perceptual mapping. This helped us accurately predict demand and align with customer needs.
When considering manufacturing, inventory and capacity control is crucial. You don't want to underproduce and miss out on easy revenue, but excess inventory will increase net working capital and hurt cash flows. It's scary to invest early when your stack is still small. You don't know your competition's tactics or what might happen down the line, but small bets result in small returns and won't help you grow for the future. Instead, prepare and take advantage of early opportunities. Don't play reckless and spend in unnecessary places. But if the chance is there to invest big, take it. Growing your stack early will allow you to be more consistent as the game goes on.
To better align with our strategic focus, we continually invested in technology on quality and safety. We opened 2 additional development centers, but later on felt limited by having only 4 in total. We also kept investing in capacity as our forecasted sales volume grew quickly following increasing market demand. Looking back at our development roadmap, we think investing in an additional development center would have helped us more. For example, at year 7, we wanted to perform a minor upgrade to Alamo but didn't have room for it. Overall, our heavy investments in technology and capacity were proven to be successful. However, an additional development center would have put us into a more comfortable position, considering it would have not only increased our flexibility, but also helped on diversifying our products and risks.
Don't be afraid of placing bets on crowded hands. It may be daunting to try to take on multiple competitors at once, but if you have invested the time in understanding your competition and practicing your strategy, you can leverage your strengths to steal some of the pot for yourself. Initially, we were hesitant to invest in Alpha because every firm had a family car. We wanted to focus on our more specialized vehicles in the economy and utility classes that had little competition. But we did a ton of market research on the 2F segment, and we found that they really value high quality and safety. These align perfectly with our firm's values. So beginning in year 4, we began heavily investing in Alpha, trying to steal the market. Every year from 4 to 9, we either improved the car or reduced its production cost, and the investment paid off. We used the fierce competition as motivation to continuously improve Alpha, and the sales were consistently increasing. We purposely kept inventory low and occasionally sold out, so we would not have to write it off the next year when we would improve the car again. In year 0, we were only 23% of the family vehicle market. By year 8, we made up almost 50% of the same market. Sticking to our core strategy of low-priced, high-quality cars allowed us to increase our unit sales and conquer the market. You don't always need a home run hand to win. Play smart and try to outbid your opponent when the opportunities are there. A steady source of easy revenue can go a long way down the road.
Looking at B2B contracts, we had not realized the benefit of doing this until year 4. Even though it does not generate as much profits, it is guaranteed. So in this world of uncertainty, this strategy might play a crucial part at some point. We started with around 24,000 units and end up with 242,000 units sold, which consists of Alex and Alpha. We recommend you utilize this B2B contract segment and identify profitable ones to partner as soon as possible. Also remember that our competitors might hop into this field and steal your contracts by bidding the lower price, so think long-term and bid. In terms of manufacturing, we also need to incorporate it into our scheduled production so that we can have enough inventories for both B2B and our retail customers. For product development, make sure the attributes satisfy both B2B and retail customers, and take this into account when planning the production development.
There's nothing wrong with being aggressive when you're playing smart and sticking to your strategy. But know who you are and what risks you face. Be cautious when faced with uncertainty. Making huge bets when you're not holding your aces can end up ruining you.
In year 7, we launched an AEV called Ariel, targeted at value seekers. Unfortunately, this product didn't pop the segment, and thus affected our earnings through year 9. We learned that we waited too long to launch a product that was insufficient to meet customer needs, and we also missed our window on high gas prices. Based on market research, we forecasted much higher demand than was actually realized. Once we launched Ariel, we saw that we had underestimated how much customer needs would change during the 3 years of development. We ended up with a large inventory of under-spec'd products that we could not change due to the high cost of write-offs. In the future, we recommend more conservative manufacturing for new products. During development, overshoot customers' current expectations to account for increasing demands over time. And finally, always keep our strategy at the center. We make high-quality vehicles, so the bare minimum approach doesn't align well with our strategy and our target customers.
When things are going well, it's easy to get overconfident. Resist the urge to make huge bets when you don't hold all the cards.
Play the long game. It is important to recognize patterns and predict competitors' strategies, and this is especially true when making predictions with inventories. The firm sometimes made decisions based on short-term and reactive gains, and this was further exaggerated by unpredictable economy. For example, with Ariel, we overproduced because we wanted to create a segment, and with Awesome, we wanted to increase market demand versus meeting market demand. As this graph shows, our average car production versus units sold was misaligned, especially for Alec, Awesome, and Ariel. Long term, this detrimentally affected our finance with increase in net working capital and larger than expected write-offs. In the future, we recommend focusing on high-quality vehicles that can be priced based on market needs year to year and investing time in maintaining accurate forecasting.
As a leadership team, prepare to challenge each other respectively and keep your shared strategic vision in mind. Be sure to align the firm's values with shareholders' best interests. Amazing Cars has strong manufacturing capacity excellent market share in targeted microsegments, and a diverse portfolio. We fully believe in the firm's mission and Amazing Cars' bright future.
So, the cards have been dealt, the bets have been placed. The rest is up to you.